Now, people don't actually buy homes based off of how much a home costs. People buy homes based off of how much the mortgage will cost them. This became very apparent over the last couple of years because even though home prices skyrocketed, people were still willing to pay top dollar and more over asking price to buy these expensive homes because they were able to get a mortgage rate that was super cheap. So if your goal is to get the best deal possible on a home, you don't want to just look at where home prices are going, you also want to look at where mortgage rates are going, and this is where we're going to start. We're going to go from the bottom up and talk about what influences mortgage rates and where mortgage rates are going. Then we'll talk about home prices. But one caveat that I do want to say before we jump into that is if you're thinking about buying a home, remember your home is the place where you live, and the most important thing isn't trying to time the market when it comes to buying a home. It's buying a home that you can afford, because the way that I look at it is your home is a liability. It's a liability until you sell it, and then you have to hope that you can sell your home for a profit where there's no guarantee. So the most important thing is that you can buy a home that you can afford, not when you buy it, but actually buying a home where you can comfortably afford the cost of the home. The two major factors that influence mortgage rates are the Federal Reserve Bank and inflation for two different reasons. First, when it comes to the Federal Reserve Bank, the Federal Reserve Bank is the central bank here in the United States, and they're the entity that's in charge of interest rates. Now, while the Federal Reserve Bank can change interest rates, they're not changing mortgage rates. The interest rates that the Federal Reserve Bank influences is called the federal funds rate. This federal funds rate is the interest rate that banks pay one another for overnight lending. So you can kind of think of it like the wholesale price that banks have to pay to borrow money, and then they sell you this money at the retail price. Banks pay a certain rate to borrow money. This is the federal funds rate, and then they're going to mark it up and sell it to you at the mortgage rate, which is the retail price. So when the Federal Reserve Bank raises interest rates, the cost to the bank goes up, which means that they're going to have to raise their price to you. The way inflation influences the mortgage market is a little bit more complex because it has to do with two factors. You have to look at inflation and you have to look at the bond market. Bonds are loans, and in this bond market, you have the ability to loan money to the government. This is called a treasury bond, and you can also loan money into the mortgage market called mortgage-backed securities. Now, when you have high inflation, that means that the value of the dollar is dropping. So when you have high inflation, people are typically worried about the health of the dollar because that means the value of the dollar is going down. Now, when the value of the dollar is dropping, that makes it less attractive to people to loan money to the United States government because the government relies on the health of the dollar, right? Our dollar is our reserve currency here in the United States. So when people are worried about high inflation, they don't want to loan as much money to the government because they're worried about the health of our economy, they're worried about the health of the government, they're worried about the health of the dollar. Now, the government, in order to attract more investors to loan money to the government, meaning to get more people to put money into treasury bonds, the government will then have to raise the yield, meaning raise the interest rate that they pay on these treasury bonds. So when you have high inflation, that means that the treasury yield also goes up, meaning that the interest rate that the government pays also goes up. High inflation, higher treasury yields. But the issue here is treasury bonds are known to be the safest investment around. Why? Because these treasury bonds are backed by the full faith and credit of the United States. You'll see why this all matters for the mortgage market in just a second. So if the treasury market, the treasury bond market is supposed to be the safest yield, that means it should also give you the lowest return. Because risk versus reward. Higher risk should give you higher potential reward. So now, if the treasury bonds have to go up in yield, meaning the government has to pay you higher interest rates, that means then for the mortgage market, mortgage-backed securities, they're going to have to give you an even higher yield because it would be a really weird scenario if you could get a better return on your money by lending your money into the mortgage market than lending your money to the government. This wouldn't make much sense. So this is why when you see treasury yields go up, you also see mortgage rates go up because you have to have a higher yield on these mortgage-backed securities and mortgage rates in order to compensate for the higher treasury yields. So when you have high inflation, that forces treasury yields to go up, which also forces mortgage rates to go up. These two factors together then influence which direction mortgage rates go. If you enjoyed this short clip from my longer videos, here's another clip that I think you'll love. And while you're at it, if you're interested in learning more about how to start generating passive income, our team put together an amazing guide on how to start generating passive income for free. All you gotta do is click that button right over there. Thank you for watching, and as always, keep hustling.